So the thing everybody's talking about in real estate, interest rates, mortgage rates. When are those mortgage rates going to come down? Because right now they're in the sevens, and this is it sucks. Everybody's ready for them to come down. When's it going to happen? Is the dominating question we have in real estate right now. I'm going to give you a little bit of insight. We're going to dive a little deeper into what's holding it up. More importantly, what's it going to take for them to come down? Because I think three things have to happen for the interest rates to come down later on this year and in the beginning part of next year. And I think that they will. But these three things, all three of them have to happen for that to happen. What does that mean? Steve, Malone Home Team, EXP in the Atlanta area. All right, so if you find value in this, please give me a like, give me a follow, help me out, get some Google juice, get some people to watch our channel so we can keep spreading all the good news and keep spreading all the pertinent news. Sometimes it's not good. The interest rates definitely fall into that category. So, like we talked about, let's break it down. Why are the interest rates where they are right now? And then we're going to talk about the three things that have to happen. And I'm going to give you my idea of what's going to happen going forward. We're going to try and keep it quick. Let's rock and roll. Let's make things happen. Here you go. Let's talk some interest rates. Ugh, it could be ugly. We'll talk about it nonetheless. First of all, why are the interest rates as high as they are? They are in the low sevens right now. Historically, it's really not bad compared to where it normally is historically. The issue that we have right now is that the overwhelming majority of people have interest rates on their current home or mortgage rates on their current home are way below where they are right now in the free market. Right? In the market right now, you get them in the low sevens. 92% of people who have a mortgage on their house have an interest rate below 6%. Okay, and I think it's 70% are actually below 4%. It's a crazy number of people who have interest rates who are much lower than where we are right now. For that reason, a lot of people, if they don't have to sell, it makes no financial sense for them to sell right now. So, that being said, why are they so high? Well, the question is, why were they so low? That's really more the pressing issue. They were so low because of the pandemic. They're so low because the economy was kind of a little slow, let's say, before going into the pandemic, and it was doing better, but interest rates are still holding in the fours and the fives. And then the pandemic hit, and then we saw interest rates fall down to the threes, and we actually got down into the twos for a while, and we kept telling people, jump in, jump in, jump in. And the problem was everybody was in the pool looking for a house. There were no houses out there, so you had, fist fights in the driveways. You had, 100 offers on every house. It was just crazy, okay? Back to normal real estate now. Now that we're back to normal real estate, we have a normal supply of buyers. The supply of homes is a little bit less than we typically see. It's more than it was during the pandemic, but it's less than we typically see on average. Coming out of July, we have about half the number of homes on the market in the U.S. than we saw pre-pandemic in July. Okay, so we definitely have a lack of housing. But the issue is the economy is actually not doing too bad. We're not going to get political on this. The markers that we use to figure how is the economy doing, the economy is still producing. The economy is still moving. A lot of people talk about that there's still a lot of that, the pandemic money that was given out by the government, some of that stimulus money is still working through the economy. So there's still money out there working through the economy. Because of that, the economy is still in strong shape. When the economy is in strong shape, interest rates are going to be a little bit higher. We say this all the time. Mortgage rates are an indication of kind of the strength of the economy and the strength of things going on. If you have bad economic news, you're going to have better mortgage rates. If you have great economic news, you're going to have worse mortgage rates. That's just the yin and the yang. Okay, that's how it works. We had bad economic news during the pandemic because a lot of people weren't working. Everybody was stuck at home. Nobody knew what was going to happen. Things were not pretty. That's why the mortgage rates are in the 2% range. There's a lot more certainty going forward now than there was then as far as what's going to happen. And for that reason, mortgage rates have risen back up into the 6 to 7% range. Now, right now, as of this recording, in the low sevens. So what does that mean? I mean, it means that the interest rates are higher than they've been, but they're really not crazy right now when you look at it historically. If you look at all the markers and you look at everything, like where should they be? They probably should be in the upper fives, low sixes, and I think that when we see the rates go down, that's where we're going to settle. I don't see them going back in the low fives, upper fours anytime soon. I think upper fives, low sixes, if we can get there, that's the sweet spot. See if you can get a house at that point. I think people would be more willing to come out of having an interest rate, let's say, of 5%, than get something at 6% as opposed to like 7.5%. Okay, so that's where the interest rates are right now, and that's why they are where they are right now. They are where they are right now because economy-wise, things are not in bad shape. Things are still holding on, despite everything that the Fed's going to do, or the Fed's been doing. Fed has been trying to raise the Fed funds rate. The Fed funds rate, and that's the one you hear about all the time. The Feds have raised their rates. Fed funds rate. That's the rate that banks lend money to each other, okay? And they're trying to raise that up because if they raise that, it's going to slow down spending. It's going to slow down the economy. And you've got to bring the economy in check, to bring inflation in check, bring all that stuff in check. And then things are going to just kind of flatten out, kind of flatline or whatever. That's kind of what they want, everything to be flat. Not too high, not too low. We want to Goldilocks this mess, and we want to be just right, okay? So that's why the rates are where they are right now, okay? 3 things have to happen, big things that have to happen for those mortgage rates to really take a big dip down, okay? So let's break all 3 of them down. Number 1, we're going to start with inflation. Inflation is in a much better spot now than it was this time last year. When you look at percentage-wise, this time last year we're like 8.5% inflation, which is crazy. They wanted to be about 2 to 2.5% a year. Over the last year, it's come down. Now it's like 3 to 3.5% right now. Much, much better. We're not quite there yet. Okay, the Feds have been raising the Fed funds rate pretty aggressively over the last year to try and combat that. And it's showing signs that things have improved and that things are working because, the inflation number has come way down. We're in that 3 to 3.5% range. It's going to continue to drop down, and we're eventually going to end up in that 2.5% range. That's kind of where they want it to be. We still have a little bit of room to go. So that's the one that I'm not quite as worried about because it's working right now, doing exactly what everybody thinks it's going to do. It's dropping down. So the Fed funds rate, which we'll say, I'll try and make this as clear as possible because sometimes it gets confusing. The Fed's rate, when they hear that the Feds have raised their rates, the Fed funds rate is not the same as mortgage rates. Okay, the Fed funds rate, not the same as mortgage rates. They act very similar. Okay, a lot of times the Fed funds rate goes up, the mortgage rates go up. A lot of times the Fed funds rate goes down, the mortgage rates go down. But that's not because they're connected. Mortgage rates really act more on economic data. What's going on? They're driven by bonds, they're driven by mortgage-backed securities, they're driven by a lot of things. Okay. The Fed funds rate is driven by the economy. If the economy is too hot, they're going to raise the rate to cool it off. If the economy is lagging, they're going to drop it to kind of keep the economy going. So as it reacts to the economy, mortgage rates are also reacting to the economy in a similar way. But again, they're not connected. They're just kind of reacting to a lot of the same stuff. That's why you'll see sometimes the Feds have raised their rates like a quarter point or a half point, and the mortgage rates may actually go down that day, which is kind of weird. And people will be like, what does that mean? The reason why is because everybody knew that the Feds were going to raise their rates. They kind of telegraph what they're going to do so they don't freak everybody out. They say, yeah, we're probably going to, they leak it or they tell it, whatever, hey, we're going to raise this. Percentages show that it's going to raise. It's going to go up 0.5%. It's going to go up 0.5%. It's going to go up 0.5%. They hit that. And then the day gets here, and guess what they do? They go up 0.5%. Anybody following any kind of financial news is not shocked in the least because they said this is what we're going to do. So that's why the mortgage rates, which are driven a lot by some economic news and data and stuff like that, they've already seen that they're going to raise it 0.5 point. They're not shocked at all. They did exactly what they were supposed to do. That's why mortgage rates can drop, because mortgage rates are moving in a lot of different areas, not just what the Fed does. Okay, so that's kind of a little bit of the difference between the two. But that being said, if the Fed turn around and start dropping their rate pretty quick, that's going to be kind of a sign to everybody that things are improving and the mortgage rates are really going to take a discernible drop. Okay, so we're really watching inflation because that's what the Fed funds rate, that's what they're trying to do with that rate, is to curb inflation. It has curbed a lot. We're in that 3 to 3.5% range. We got to get to around 2.5%. We're almost there, not quite, maybe later on this year, but that's the first domino that has to fall. Got to get inflation back to that magic number, 2.5. So the second one is the one that I get a lot of people look at me and say, what you talking about, Willis? Unemployment right now is too low. What? What do you mean? That's great news. Lots of people are at work. It is great news. We want everybody to be at work. We want everybody to have a job, support their family. That's what we want. Okay? In the world of high finance, in the world of the Fed, unemployment should be at about 5%. That's deemed kind of a healthy balance of employment. Okay? The unemployment in the U.S. is in the upper threes right now, not at 5%, in the upper 3% range. Some people will say, again, from a political standpoint, oh, that's not correct. They're cooking the books or whatever. Believe whatever you want to believe. Okay? In some ways, they may be cooking the books. Okay? I'm not going to say that that's impossible. Okay? I wouldn't be the first person to lie about their numbers to make themselves look good. Okay? It happens all the time. It happens all parties. We're not going to get involved in that. All I'm saying is the number that's on the table right now is the number that's in the upper threes, like 3.7% right now. That number needs to come up. We need a little bit higher unemployment. It stinks, but it is what it is. What the Feds are trying to do is they're trying to slow down the economy by raising their rate. Okay? They will start bringing the Fed funds rate down once they feel like unemployment's in check, because that's going to mean that the economy's kind of in check. If there's too low of unemployment, what that means is companies are paying way too much money to get people to come work for them because there's a lot of competition, things like that. Get to 5%, again, it's in that healthy range where the inflation is not too crazy. You got the right number of people employed, things like that. If it's 3.5%, you got to get, I got to pay somebody a boatload of money to come work for me because there's no pool of people to employ because unemployment's so low. So for that reason, that's going to keep inflation high. Okay, we need the unemployment rate to come up to 5%. It sounds weird. You need higher unemployment to mean that mortgage rates are going to come down. Because again, like we said earlier, bad economic news, good for mortgage rates. Okay, the economy is doing good, mortgage rates are going to stay high. The economy starts to slow down a little bit, which is what the Fed's trying to do to try and bring everything kind of in line, trying to get that Goldilocks approach, trying to bring everything back down. As that happens, the mortgage rates will come down, unemployment has to go up. So we need unemployment to get a little bit closer to 5%. That's probably not going to happen until later this year or early next year as well. Okay, so that's the second domino. So we want inflation to come down to that 2.5% range. We need unemployment to go basically to about 5%. And then there's number 3. Third thing that we need to happen, a little time's going to have to go by. This is going to be the unpopular one. And it stinks, but the Feds are ready to do it. Because the Feds do not want to do all the work that they've done, create all the turmoil that they've created, and then turn around and take their foot off the gas, when things kind of look like things are improving. If we get inflation to 2.5, we get unemployment to 5, they are not going to immediately go, take all the rates back. They're not going to do that. They're going to very slowly back off of it. Okay, so rates right now, the Fed funds rate is basically in the 5.5 range. They may pull it back to maybe 4.5 or so by this time next year, but they're going to slowly do it. But even then, in the beginning, it's going to be very slow. They want to be sure that everything that they've done, all the work that they've done to slow everything down is going to take. They don't want to take their foot off the gas too soon and allow for the economy to take off again, and then they got to raise rates again and all that stuff. Okay, so like I said, once we get inflation to 2.5, once we get unemployment to 5, those are 2 things that we're watching. That's going to mean, all right, the Feds have done what they wanted to do. And the third thing is they're going to slowly take their foot off the gas. They're going to let some time go by, okay, which is, it's going to stink in the long term or in the short term, but in the long term, it's going to make the most sense. It's the best thing for the economy. And then as they slowly let off the gas, we'll see that the economy is just going to kind of slip right into that kind of middle ground, which is where they want it to be. If that happens, then you're going to see mortgage rates really take the discernible drop, but I don't think it's going to get back down, like way down in the 4s and 5s. But you're going to see a big drop in the mortgage rates. And this is a point that I want to make, because I think a lot of people think that the Fed's dropping their rates is the only thing that's going to drop the mortgage rates. Mortgage rates, again, they are based on a whole lot of things. Okay, a lot of economic data, mortgage-backed securities, bonds. The Fed funds rate, is an indication of the strength of the economy. Strength of the economy is one of those things that drives mortgage rates. So again, they kind of act in concert, so to speak. As we head over the next year, the mortgage rates are going to drop, independent of what the Feds do. But really, when the Fed start making big moves, that's when mortgage rates are going to make their big moves. Okay. So I say all of that to say, what do I think is going to happen next? Here's my prediction for the rest of this year, beginning of next year. So right now, interest rates are basically mortgage rates. Let's say mortgage rates are basically low to mid sevens. Okay, with the interest rates in the low to mid sevens, this is probably the top. Now we have said that a lot of times when we're right at 7%. The problem is last couple weeks it's been very kind of quiet. It's been very kind of stagnant as far as news and everything. But the problem is that stagnant was still leading to some buoyancy in the mortgage rates. They got up to about 7.5. I think they hit a lot of resistance at that 7.5 mark and have been coming down since. So as of this recording, we're like 7.25 right now. What do I think is going to happen? I really think that we're going to see a steady drop between now and the end of the year. It's not going to be a major drop. We may get back down into the upper sixes by the time we get to New Year's. Okay, I think we're going to get in the upper sixes by the time we get to New Year's. Okay, once we get into the upper sixes, then we turn the page into 2024. I think the Feds are going to hit all the numbers they want to hit. They're going to let some time go by. The economy is going to show some strength, show some resiliency, and they're going to start dropping their rates. They're going to start dropping their rates, and that's going to be a relaxation of all the work that they've done to kind of contract the economy as much as they can. And it's going to be a sign that the economy is not as rip-roaring as it was because of all the work that they've done. Okay, and because of that, I think the mortgage rates are going to have clearance to kind of come down at a little bit faster rate. So I think we're going to be upper sixes by the time we get to around New Year's. By the time we get to spring, mid sixes, could we be in the low sixes by spring? It's not going to be as fast, in my opinion, as a lot of the mortgage people are thinking. I think a lot of the mortgage people, and I follow them, we listen to them, and there have been a lot of people who've been thinking that things are going to move a lot faster than they have this year. Okay, and I'm of the opinion now that we need to just chill. Okay, let these mortgage rates do what they're going to do. We're not going to force them down. We're not going to wish them down or whatever. One of the things one of the things that we're talking to our people about, and a lot of people talking to their buyers about, is by now you've heard 1,000 million trillion times, marry the house and date the rate. The problem is that rate that you're going to be dating, you might date that rate for quite some time. Okay, because if you get something in the upper sixes, I don't think the rates are going to get appreciably lower than that. They might get in the upper fives to low sixes when it's all said and done. That might not be till the end of next year. To me, I don't think that we get, naturally, as we get closer to a national election, interest rates are going to get better. It's amazing how that works. To me, I think that, if I had to put my money on what's going to happen, by the end of the year, we're at about 6.8, something like that. By springtime, we're at about 6.4 to 6.5. And by the end of next year, we're close to 6. That's my bet. And I hope I'm wrong and it goes a lot faster than that. Because if it goes a lot faster than that, everybody and their mother's coming back into the pool. Because a lot of people are waiting for upper fives, low sixes to jump back in. If you're waiting for interest rates in the fours before making a move, I would highly suggest you jump in a lot faster than that. Because I do not know when that's going to happen. I do not know if that's going to happen. Really, it never happened before we had all the craziness going into the pandemic. Okay? So that's my guess. My guess is we're going to have that slow and steady drop. To me, there's really no forces driving the rates up at this point. Okay, I think it was more of a wobble because of the stagnancy of the market. And they kind of wobbled up and they hit that 7.5 and everybody said, holy cow, and all of a sudden everything came way down. Because it's down about a quarter since it hit that number last week. So it's had a big drop. Like I said, I think 6.8 by New Year's, 6.4, 6.5 by March 1st, and then right at 6 by the end of next year. That's my guess. We'll see how it works out. I'm going to send you, down below, there's a link to a guy that I follow and I watch his video every day. His name is Dan Frio. He's a national mortgage broker. He's licensed in all 50 states and Puerto Rico. Watch him every day. If you are a realtor watching this, you have to watch him every day. This is your job, is to know your crap for your people. Okay, because your people expect for you to know, hey, what's going on with mortgage rates? You cannot say, I don't know, go talk to a lender. It's not going to work. Okay, things are too crazy. Okay, we've got to be up on this. Watch Dan Frio. Link down below. Watch him every day. He's much, much smarter than I am when it comes to all this stuff because that's his jam. Okay? Now, I watch his stuff, kind of know what's going on. My jam's finding you a house, despite all the craziness. So, if you want to talk about, if you want to have a strategy session talking about when's the best time to strike, when's the best time to go, because obviously there's a lot less demand now than there's going to be this time next year if the interest rates go way back down to the low sixes. Okay, if they're in the low sixes this time next year, there'll be a whole bunch of people looking for a house. And you have like 20, 30 offers on houses, things like that. Maybe it makes more sense to buy now, but everybody's situation's different. So let's talk strategy. Give me a call, 470-233-4409. Email is below. Again, if this has provided any value to you, hit the like button, subscribe, hit the bell. I'd say smash the bell, but that's like overplayed. So just hit the bell. Go lightly tap it. That'd be fantastic. We'll take it. Steve, Malone Home Team, EXP. Take care. Bye.